Want to welcome Mark Smith to the conversation as well. He's a financial advisor at UBS. Mark, what is the level of optimism or bullishness from your clients right now at UBS?
Everyone's very optimistic because the market's at all-time highs. The issue is, where do we go from here? And there's a lot of headline risk. The election, number one concern for our clients. Also, double-digit unemployment rates. So there are a lot of negative headline news that could come out with the elections looming over us in November. So everyone's is staying pretty defensive right now.
So are you telling them not to chase this rally? Is that what you're saying?
I'm telling my clients, if you are someone who has a 30-year time horizon, I'd say keep to your asset allocation, continue to dollar cost average into the market. But if you're someone who's looking to retire in the next couple of years, I think you should start taking some money off the table and waiting to see what happens in November.
What about some of those risks, Eugene? Are they reflected in the market, the election risks and the uncertainty there, the stimulus risks? Everyone just expects more fiscal stimulus, but Senate's still on vacation. Not to mention the double-digit unemployment that Mark mentioned. Do you see that being priced in at all?
I don't think it is, but I think that certainly investors are very optimistic and they are looking for reasons to bid the market higher. But even if you look at the consumer confidence report today, for the last 2 months, that's been declining. And that seems to be consistent with the fact that we haven't gotten confirmation of additional stimulus, right? And you also have a situation where a lot of companies aren't giving guidance. The ones that are guiding lower a little bit to kind of tap down enthusiasm, but that doesn't matter. It feels a little bit like the dot-com end of the bull market there, where companies rushing to go public, here the IPOs in the cloud space, and investors don't want to be left sitting on the sideline with this type of run, so they begin to stretch the fundamentals or stretch their analysis of the fundamentals, and I think that's what's going on. And I don't know when it's going to end, but I don't think this is sustainable, and I'm not sure that November is kind of the key point on what's being looked at, because analysts are taking earnings out to 2021, 2022, sort of whatever it takes to take target prices higher.
A lot of people probably listening and watching would agree with you, Eugene, but then there's FOMO. There's fear of missing out as this market just zooms higher every day. So how are you positioning to reflect that kind of skepticism that you see on the market, but also participating in it in places like technology, which I know you shared you liked?
Yeah, well, you a lot of times use a barbell approach. You hear that quite frequently, where you'll have the FANG stocks on one side, but then you're looking at some more valuation-sensitive stocks on the other side. I think Salesforce is sort of that type of security where essentially it's still leveraged a lot to enterprise type of software, even though it's a subscription-based model. But what we're looking for is, in the first quarter, 20% of earnings came from their investment in Zoom and some other companies. We're looking to see how that subscription model is actually growing, how far they're going over in artificial intelligence. And I think they're only up about 19% this year versus where NVIDIA is up, which we also own, right? So when I'm talking about valuation sensitivity and looking at plays that are not as high as some of the other investments in the market, I'm looking at companies like Salesforce, but I also own NVIDIA on the other side of the portfolio, because one thing you don't want to do as an investor is be in cash, the market's up as much as it's been 40% off the lows, and you've sat in cash. Clients just don't want to hear it, even though risk reward says that's where you should be. You have to stay fully invested, because the market is the best barometer of its own performance.